Welcome to Saving the Investor with certified financial planner, investment advisor, and insurance professional Alfie Townsend, president of Advantage Retirement Group.
Good morning, Southwest Florida. You're listening to Saving the Investor radio show. I am Alfie Townsend, Southwest Florida certified financial planner professional, here with John Antonucci, and we have a special guest. I'm going to tell you a little bit about him after John says his thing this morning. Good morning, John.
Good morning, Alfie. Great to be in studio with you. You know, Alfie and his expert team are dedicated to helping investors just like you master the complexities of the ever-changing investment landscape. And today is no exception. We've got a real exciting show on tap. Today we have a special guest joining us. Whitney Stewart is a Wyant portfolio manager from Sterling Capital. And together we'll dive into the current market environment and uncover incredible opportunities for equity investors who want to take advantage of market conditions during this election year. But that's not all. We'll also tackle hot topics like consumer debt, government spending, and the revolutionary impact of AI on the stock market. This is a show you don't want to miss. So if you have any questions or topics you'd like us to explore, give Alfie a call at 239-747-1077. That's 239-747-1077. Stay tuned and let Saving the Investor be your trusted guide on your financial journey.
Thank you, John. And again, we have Whitney Stewart. He's a client portfolio manager from Sterling Capital Management, assets of $77 billion of AUM and AUA. And Whitney has been with Sterling for, over 6 years, but in this business, in the financial business, investment, I should say, experience for 18 years. And he has a BA degree of economics at the University of North Carolina, Chapel Hill. He holds a chartered financial analyst. That's a CFA, very tough designation to have. And he resides in the suburbs of Philadelphia. That's a rough city over there. But we want to welcome to the show Whitney, and really I want to start by this broad macro question. How do you think about how do you think about this current market environment that we're currently in? And welcome to the show, Whitney.
Well, thank you, Alfie. I appreciate the time today to spend with your listeners, and thanks for that kind introduction. I'm glad to be on the show today. In terms of the current market environment, there's a lot going on. With both macro and micro factors that's driving the markets today. And I think it might be helpful for your listeners to go back and understand how we got to this moment in this environment and look at history as a guide to hopefully project into the future what may happen with markets. So if you go back to 2022, markets were really challenging. Equities, bonds, traditional 60% equity and 40% bond portfolio all declined by double-digit numbers in 2022 as the Federal Reserve surprised investors by raising rates at the fastest pace in modern history. Then in 2023, you had a reverse impact in essentially the opposite of 2022, where equities, bonds, and that 60-40 portfolio all rebounded after inflation data moderated. And then the Fed eventually stopped raising rates in October of 2023, which led to a liftoff in all asset prices towards the tail end of 23. So that's the setup into 2024.
Gotcha. So how did investors generally position their portfolios in 22 and 2023?
Yeah, good. Great. Another great question. It's a little counterintuitive. When you look at investor flow data, which is essentially where are incremental dollars going in markets, U.S. equity fund flows actually declined in 2022 when the market was falling, and then also in 2023 when the market was actually rallying, which suggests that investors were selling stocks in both 2022 and 2023. And so then the next question is, well, if they sold stocks, what were they buying? Money market flows, which is essentially cash money market funds, increased to an all-time high, well over 2.2 trillion. And some metrics over 7 trillion in total assets and cumulative money market assets. And that's driven predominantly by the Federal Reserve raising rates to over 5%, which implies that investors were then selling stocks and then adding to money markets and U.S. Treasuries in order to get that 5% return, which was much higher than previous money market returns. And it's quite possible that U.S. investors may be overweight cash now and underweight equities in their current allocation.
So that's probably sounds a little bit like market timing. We talk about that all the time. So some investors may have missed out on some of the equity rebound that 2023 gave. And what drove this equity rebound, what really drove the equity rebound in 2023? And will this continue, you think, in 24? We're having a pretty good year so far, but what do you see the rest of the year at?
We get that question a lot. You know, will this rally keep going? The equity rally in 23 was really driven by two factors. The first being the lack of a U.S. recession, which a lot of forecasters were expecting, which didn't happen. And then a strong U.S. consumers surprising investors. And then the second contributor to the strong equity rally last year was that the Fed stopped hiking rates. They got to the high end of the range, and then they paused in October of 2023, which led to that everything rally in November, December of 2023. The equity markets perceive the Fed pausing their hiking cycle as bullish because the next move after a pause is likely a Fed cut. And that's based on history and historical data. It's difficult to predict if this equity rally will continue thus far in 24 and beyond. However, when we analyze historical trends in an attempt to understand possible outcomes for the future, you know, the S&P 500 has averaged 59% positive returns after inflation has peaked in the previous 7 cycles. And if you looked at this cycle, inflation peaked in the summer of 2022. So that wasn't a perfect buy signal for equities, but it was quite close as the stock market did bottom in October of 22. Another data point for your listeners is 5 out of the last 6 hiking cycles have resulted in positive returns for the S&P 500 index 2 years after the Fed's last hike. So in my opinion, this provides another positive data point to suggest the current environment may be attractive for equity investors as the next move for the Fed appears to be a cut in rates, which again, historically has been bullish for equity investors.
Boy, that sounds good. You're listening to Saving the Investor, and we have Whitney Stewart here, portfolio manager with Sterling Capital. And we want to go back to, there's so much to ask you right now, Whitney. We're coming close to a break. But what you were just explaining, it sounds like history may suggest that now may be an opportunistic time for equity investors. But we're going to talk about inflation when we get back, and reaccelerate the cause for the Feds to rate hike. So hopefully we're not going to get that. But we're going to keep that question, and John's going to bring it to the break, and then we'll be right back.
Yeah, great information, Alfie, and great information, Whitney, on this topic that we're talking about today. You're listening to Saving the Investor radio broadcast with certified financial planner professional Alfie Townsend. You know, Alfie has over 40 years experience as a certified financial planner professional. He's also a fiduciary, which means his responsibility is to you, not the products or services that he offers. And if economic uncertainties are putting your financial decisions on hold, you really need to get a hold of Alfie's free toolkit that will help transform your worries of retirement into confidence. You know, Alfie's toolkit will give you a wide range of materials, such as, will your money last as long as you do? That's a question that you have to answer, and you have to know going into retirement, or if you're currently retired. Are you paying too much in taxes in retirement? If Alfie can show you how to lower your tax liability each and every year, obviously that's going to put more retirement funds in your pocket. The Social Security Decisions Guide, when is the most opportune time to take Social Security if you have not taken it yet? To get Alfie's toolkit, all you simply have to do is call the operator or text the word KIT, that's KIT, to 239-747-1077. Again, call the operator, ask for Alfie's free toolkit, or text the word KIT, KIT, to 239-747-1077. It's time for a worry-free retirement. Get Alfie's toolkit today, 239-747-1077. You also can visit Alfie on the web by going to savingtheinvestor.com. Again, his web address is savingtheinvestor.com, where you will find a wealth of information about Alfie, his incredible company, and all the services that he offers here through the Advantage Retirement Group. We're going to be right back. We're going to be talking again with Whitney Stewart, client portfolio manager from Sterling Capital. So we don't want you to go away. Stay tuned. We'll be right back after this break. Welcome back to Saving the Investor with certified financial planner professional Alfie Townsend. You know, Alfie has over 40 years experience as a certified financial planner professional. And Alfie is a retirement planner. He's going to put an income plan together for you. He has what's called a retirement simulator process that will take a deep dive into your current portfolio to see what's really going on. He's going to expose all the hidden fees inside your returns, make sure you're not taking undue risk for the amount of return that you're getting. He's going to make sure that you're allocated properly, also diversified correctly. And you can visit with Alfie in Fort Myers or Naples. He has 2 beautiful offices. All you have to do is call the operator or text the word VISIT, VISIT, to 239-747-1077. That's 239-747-1077. Visit with Alfie in Fort Myers or Naples today and get your portfolio examined by someone who has many, many years of experience as a certified financial planner professional. And we are back with Whitney Stewart, client portfolio manager from Sterling Capital. And before the break, Whitney, Alfie was touching on the fact of inflation and how that is an impact to many investors. You know, is there opportunity right now for equity investors, even in the midst of an inflationary market?
It's a great question and very popular topic, and probably one of the biggest risks to the current equity market cycle. It's possible that inflation may reaccelerate. It's a clear risk to equity markets, in my opinion. But inflation is trending lower. Consumers are starting to push back on these higher prices, which may lead to a further reduction in inflation. Alfie, I don't know if you've shopped for a new car or a new boat or used car or used boat recently, but now you can all of a sudden get some pretty good deals and percentage discounts because the dealer lots are full, which is the exact opposite experience to shopping for those same vehicles and boats just 2 years ago. Inventories have increased. Consumers are showing signs of weakness, particularly the younger and lower end consumer. For example, the U.S. auto loan delinquency ratio, which is essentially consumers can't pay their auto loans at U.S. banks, reached the highest level in the past 10 years at the end of 2023, according to S&P Global. Additionally, the Fed has cited that 6.9% of credit card debt transitioned to serious delinquency in the first quarter of 2024, which is up from 4.6 a year ago. That's a 50% increase in the amount of serious delinquency on credit card debt. Gen Z and millennials have the higher percentage of maxed out credit cards. That's 15.3% and 12.1%, which is well above baby boomers at 4.8%. So you're seeing that generational challenges with the younger generations. Additionally, the average interest rate on a credit card is 27.65%, according to Forbes, as of earlier this month. And 80% higher than the 15% rate in 2019. So not only are the debt levels increasing, but the rate on that debt, is almost 30%, which is a significant number. And that's causing a pinch for lower end consumers and younger consumers. And due to this increasing stretch on the U.S. consumer, small and medium-sized businesses are also feeling an impact with higher borrowing rates. And the Fed continues to signal their next move is to cut rates as opposed to hiking rates.
Whoa. Wendy, that's a whole lot of information you gave, and it sounds to me like, well, that 28% on credit card debt, that's not a good thing. That's absolutely nuts if you think about it. 28%, and there's a lot of people that are maxing out their cards, according to what you were saying. And how's that going to have an impact on consumers with credit card debt? Will the Feds, you think they're going to cut rates soon? And if so, how many rate cuts you think we're going to have this year?
So the Fed had a meeting this week, and there was additional inflation data, and the futures market at the beginning of April priced in 3 or 4 cuts in 2024. Now, the inflation data has been a little bit stubborn. But the most recent data, the Fed futures markets are pricing in 1 to 2 cuts with a over 70% chance of a cut in September. So that's based on futures market expectations. Historically, equity investors have added capital in anticipation of Fed rate cuts, and that has historically helped fuel multiple years of attractive equity markets, as we talked about earlier.
That's some good news. That makes sense. But what about the recent equity market volatility? And and risk for equity markets?
There's always risk in equity markets, Alfie, as you know, and I'm sure your clients and listeners know. And investors in equity should expect drawdowns. It's part of equity investing. However, investors that have been patient and focused on long-term equity returns have generally been rewarded with disciplined investing strategies in equities in general. For example, a 10,000 investment in the S&P 500 in 1980 would be worth $1.371 million at the end of 2023. However, if that same investor sold $2,000 worth of stocks and moved it to U.S. Treasury bills every time the market dropped 8% in a month, the value of that account would have dropped to $615,000 from that $1.37 million. So more than a 50% drop. The message there is don't panic sell, stick with your strategy. The old adage of buying the dip and being greedy when others are fearful appears to work over time, but there's no guarantee. The other key point is if that same investor were to add $2,000 to that when the market dipped, every time the market dipped 8% in a month, the value would actually move up from $1.371 million to over $2 million based on historical data. So again, investors that stick with their strategy is definitely better historically than reducing equity exposure when the market declines. But potentially investors that take advantage of market dips have done historically better off. Buying the dip has worked over since 1980 just on general S&P 500 index returns.
Yeah, that's some compelling information. Really, when you're talking about buying the dips, that's rebalancing, and that's of course what portfolios, what you want in a portfolio is rebalance, buy what's low and sell what's high, and staying the course. But also adding capital when the markets are down. That's what it's all about. You mentioned consumer debt is increasing earlier, but what about the U.S. government debt? That seems like a massive amount of debt that could cause issues for the market.
You're correct. The U.S. government debt, $34 trillion is a massive number, as of March 2024, and Fed balance sheets are either at all-time highs or near all-time highs. Balance sheet is modestly shrinking to $7.3 trillion. But according to the International Monetary Fund, the U.S. debt to GDP, or gross domestic product, ratio is 127%, which is relatively high. But you have to look at things in a global basis. It's sixth highest in the world. And one of the best ways to think about it, it's one of the cleanest shirts in a dirty hamper, so to speak. So if you look at Italy, 143% on the same ratios, Greece, 160%, Singapore, 168%, Sudan, 238%, and Japan is number one at 252% debt to GDP. So there appears to be plenty of demand for U.S. debt or U.S. treasuries, especially at over 4% treasury yields, meaning investors are buying U.S. bonds even though the debt to GDP is quite high. The U.S. bond market is the largest and most liquid bond market in the world. Although the U.S. government has a lot of debt outstanding, it's not half as bad as Japan, with 252%. And investors appear to be having a hard time trusting the Chinese government and their bond market. Additionally, nearly all of large foreign countries that have bond markets and economies near the size of the U.S. market have worse demographic issues and slower economic growth. In my opinion, the U.S. is the least bad option, and one could say the best option for investors looking for government bonds. Lastly, the U.S. debt issues could eventually become a serious problem in 10 or 20 years, but it appears unlikely to drive equity markets in the near or intermediate term.
All right, so we have some time to get this situation under control. You're listening to Saving the Investor. We have Whitney Stewart, and we're going to be right back pretty soon after these messages. But I want you to stay tuned because there's so much more. We're going to talk about AI. We're going to talk about, that's the big thing you're hearing about, artificial intelligence. I think you're going to love what you hear from Whitney, but we'll be right back. John's going to take it to the end.
Yeah, great information, Whitney and Alfie. Just tremendous information. And, Alfie doesn't market time, stock pick, or track record invest. And Alfie has just come out with his second book called Making Waves in Retirement. It's always so popular. A complimentary copy of his book awaits you. To claim your book, all you have to do is call the operator and ask for it, or text the word book, B-O-O-K, to 239-747-1077. Alfie's book is your guide to a fulfilling retirement. You don't want to miss out on the valuable insights, including many, many stories about investors he has helped save through the years. That's why he named this broadcast Saving the Investor, to save you from all the pitfalls, the schemes, the traps of Wall Street. All you have to do is text the word book, B-O-O-K, to 239-747-1077. Claim your copy right now. We're going to be right back right after this break, so don't go away.
Welcome back to Saving the Investor. I am Alfie Townsend, Southwest Florida certified financial planner professional, here with Pastor John Antonucci, and we have a special guest today, Whitney Stewart, client portfolio manager from Sterling Capital Management. So he knows what he's talking about, and we've been talking we have a lot more topics to really talk about, so I'm glad you're here. But we ended the last segment about AI, and I want to hear what your thoughts are on AI. Obviously, it's on everybody's mind, and the markets are going crazy from it. So can you tell us a little bit about your investment team's thoughts on AI?
Yes, definitely. It's been a strong factor in the equity markets really for the past 2 years and into this year. First, AI has contributed to an extreme level of concentration in U.S. equity markets. The Magnificent Seven, which are the 7 largest stocks in the S&P 500, have generally had exposure to this AI theme, and they've benefited from investor attraction to the theme. All 7 stocks you're probably familiar with: Apple, Microsoft, Amazon, NVIDIA, Alphabet, Tesla, and Meta, have a combined weight larger than the entire stock market of the United Kingdom, China, France, and Japan combined. So 7 stocks bigger than 4 countries, which has never happened before. So this level of concentration is at an all-time high. Nearly 30% of the S&P 500 is made up of these 7 stocks at the beginning of 24. And historically, when the S&P 500 concentration has reached lower 20s percentages, so other previous peaks in the tech bubble of 2000 and in 1980, the concentration has declined as a portion of these stocks underperformed over the next 5 to 10 years. Part of the reason the concentration levels have fallen in the past is because the stocks at the top of the index get crowded with capital and become too expensive. The Magnificent Seven stocks are trading at an average PE at almost 35 times earnings, while the remaining 493 companies are trading at close to 22 times earnings in the current environment.
Wow, so 7 stocks larger than 4 countries. That's interesting for sure. So does Sterling believe in AI or think it's more hype?
That's another great follow-up question on AI. We are getting a lot of questions, and I'll address that in some more detail. Sterling is generally positive on AI, and several of the Sterling equity strategies are invested in equities that may benefit from AI. From a high level, we believe that AI will make companies, processes, and human beings simply more efficient and increase productivity. According to McKinsey and Company, AI's potential impact on the global economy could be 17.1 to 25.6 trillion, which includes 6.1 to 7.9 trillion of incremental economic impact from generative AI. So those are big estimates and big numbers. But how does AI actually help humans improve efficiency? AI is very good at rules-based repetitive tasks, such as taking orders at the drive-thru at Wendy's, for example. Wendy's recently partnered with Google to pilot an AI drive-thru chatbot, which has reduced service time by 22 seconds. So customers get their Baconator, Frosty, and fries much faster, which makes customers happier. Wendy's can service more customers in less time, and the AI chatbot doesn't get paid $20 an hour, doesn't take breaks, there's no health benefits, no weekends off, works 24/7. As a result, Wendy's may be able to save cash on paying humans to take customers' orders, which may reduce costs significantly. Interestingly, AI order takers are trained to upsell customers. Would you like to try our new pull-apart Cinnabon as a new product at Wendy's? However, humans are often forgetful and busy and forget to ask for the upsell order. The AI chatbot asks for the upsell nearly 100% of the time. Thus, the average ticket or customer spend can increase, and then the costs go down, which likely increases the margins for Wendy's 7,000 locations globally and potentially for the 536,000 fast food restaurants and 600 billion fast food industry globally. So we think about other chains that are testing this pilot, this may become quite a large impact on efficiency, just in one use case of drive-thrus. Another more impactful use case is a partnership with Microsoft and Novartis, which has a primary goal to utilize AI to streamline and accelerate the discovery of new drugs for healthcare, making the process more efficient and effective. AI has the potential to revolutionize the drug discovery by analyzing vast data sets quickly and accurately, including scientific literature, clinical trial results, and patient records, which may enable identification of new drug candidates and help prioritize the most promising ones for further development. AI can design more effective clinical trials by identifying key variables and potential outcomes, as well as enable the development of personalized treatments on individual patient data, leading to more effective therapies. In other words, this AI partnership of Microsoft and Novartis could lead to faster development of more effective drugs and personalized treatments, which may benefit patients, pharmaceutical companies, technology companies, and investors in these companies. AI might help us get our cheeseburgers and Frosties faster while simultaneously helping develop more effective drugs for higher cholesterol.
Yeah, and probably get the orders correct. That's where I see the biggest advantage of there. But so we have cheeseburgers and cholesterol drugs. What can't AI do? So you mentioned Sterling has exposure to companies that may benefit from AI. Can you expand on that, please?
Yes, of course. We believe that AI will require significant amounts of compute, data computation, computer computation, data in general, and then cash or capital in order to provide these use cases that humans can benefit from. So 3 largest data centers that are capable of generating enough compute to make AI efficient on a global basis are Amazon's AWS, Amazon Web Services, Microsoft's Azure, and then Alphabet's Google Cloud Platform. All 3 of these companies also have remarkable amounts of consumer enterprise data, which may be valuable as AI models tend to be more accurate with more data. AI is also very expensive to develop and run. The computations required to generate the right outcomes for customers. Thus, the strong balance sheets and significant cash positions for all 3 of those companies may be beneficial to capitalize on the AI theme. In the short term, the stocks that have initially benefited the most from the AI theme are the semiconductor companies producing the chips and hardware required to run the computations for AI. However, we believe that software application companies that utilize AI to improve their customer experiences, enterprise productivity, and earnings growth will likely benefit from AI in the long run.
Well, I'll tell you what, that's AI is very fascinating, but obviously there's other companies and sectors that we're looking into besides just AI. But so what's Sterling? What else is Sterling liking in this market?
Yes, so there are more of the themes than AI, and Sterling has exposure to several themes. We particularly favor digital payments as well as e-commerce. More countries, particularly in the Asia-Pacific region, may continue to reduce the amount of transactions with cash and checks, and then increase the amount of digital payments through 2026. Consumers globally prefer to use a credit card, Apple Pay, Venmo, Zelle, or another form of digital payment over cash. It's simply more convenient, it's easier to track, it's faster, allows for online shopping. We believe the digital payment businesses are attractive companies as they receive a percentage of the sale of each product that is sold. Thus, the businesses are scalable and have high margins. For example, if you spend $100 on eBay or Amazon or Shopify-related website, one digital company may make $1 of that $100 on every transaction, and another may make 17 cents every single time a consumer spends $100. We believe the growth of online shopping will continue in the long term, and then we believe the growth of digital payments will continue to increase over time. Hence we like that theme.
So digital payments are another compelling theme. Switching gears to a topic that we often get questions on, what are your thoughts about the upcoming presidential election? I want you to say a couple things on it, and then we're going to go to hard break and come back on that. As a matter of fact, why don't we just save that for our last segment, because we have a presidential election and there's a lot of great information. People are asking, does the market do good? Does the market do bad during that? So let's talk about that on the next break.
Yeah, you're listening to Saving the Investor with certified financial planner professional Alfie Townsend. We're also in studio with Whitney Stewart, client portfolio manager of Sterling Capital. And if economic uncertainties have put your financial decisions on hold, you really need to get a copy of Alfie's free toolkit that will help transform your worries of retirement into confidence. You know, Alfie's toolkit gives you a wide range of materials, such as will your money last as long as you do? Are you paying too much in taxes in retirement? The Social Security Decisions Guide is in there. When is the opportune time to maximize your personal Social Security benefits? To get this toolkit absolutely complimentary, all you have to do is text the word KIT, K-I-T, to 239-747-1077. If you don't text, you can call the operator, pick up the phone, call 239-747-1077. Tell the operator I want a copy of Alfie's toolkit that he's offering on the Saving the Investor radio broadcast. It's time for a worry-free retirement. Get Alfie's toolkit today. Simply text the word KIT to 239-747-1077. That's KIT to 239-747-1077. Or you can go to savingtheinvestor.com. Again, his website is savingtheinvestor.com. And we're going to be rejoined in just a moment by Whitney Stewart, client portfolio manager from Sterling Capital. Stay tuned. You don't want to miss this last episode. Stay tuned. We'll be right back after this break.
Welcome back to Saving the Investor. You're listening to Alfie Townsend, Southwest Florida certified financial planner professional, here with Pastor John Antonucci and our special guest, Whitney Stewart. I hope you have been listening to most of this show. It's been very intriguing. He brings a different aspect to investing because he is a CFA, which is a very tough designation to accomplish. And I want to bring him back as Whitney, we were just talking about, we have a presidential election coming up, and what does that typically mean to the stock market during that time?
Saving some of the tough questions for last. So I appreciate that, Alfie. Regarding the election, we attempt to put our political views aside and simply look at how does the election impact equity markets and how has that impacted in the past. Since 1950, U.S. stocks have averaged returns of 9.1% in election years, and then 8.3% positive returns in the first year post-election, according to data from Fidelity. Thus, history would suggest that elections tend to have less impact on the market than politicians may like to believe. And the U.S. stock market has similar performance data in nearly all previous scenarios, which include if the incumbent party wins, loses, incumbent Democrat wins, loses, the median rally and corrections are generally pretty similar. So why does the data suggest the election is not as important as equity markets, investors and politicians might think? One explanation is that the U.S. president is only the head of the executive branch of government. Historically, it's been difficult time making significant legal changes without the help of Congress or the Supreme Court. Oftentimes, the president isn't of the same political party as both the House and the Senate, which may cause gridlock and reduce the uncertainty. Which in other words, the change in significant laws and rules of the road are likely to remain the same as you have that gridlock historically. The stock market doesn't like that uncertainty. Therefore, when you have gridlock, it's actually a favorable environment for equities.
So that data really suggests that the U.S. presidential election is not as important to the equity market as politicians tend to think. So that's given all this macro risk that's out there, what is Sterling's thoughts on really stop losses and hedging equities? There's a lot of questions about that. Should I put stop loss on there? I'd like to get your viewpoint on that.
Yes, another great question. Sterling's equity solutions focus on long-term investing in high-quality companies that allows our clients to benefit from the compounding of equity markets over the long run. This long-term focus reduces the need for trading, stop losses, hedging, and less trading reduces the impact of trading costs as well as tax impact. Additionally, Sterling utilizes a team of full-time investment professionals that are monitoring our holdings on a daily basis, which also reduces the need for stop losses or hedging of positions. With that said, some investors do use stop losses and hedging techniques effectively. In general, a stop loss order guides a broker to trade the stock at a given price whenever it reaches that price. And a stop loss order can limit the total loss of an individual security like a stock. There's several pros and cons of a stop loss order. Let's start with some of the pros. They're generally free to use, so investors may pay a transaction fee once the stock is sold, but the actual stop loss typically doesn't have a cost. Stop losses orders can reduce losses as the stock will be sold at a specified price, and the stock could go lower after the stop loss is implemented. Stop losses can reduce the need to monitor stocks on an individual basis as the stock is sold at that specific price. If bad news comes out and drives the stock lower, it simply will be sold regardless of whether or not one is monitoring it. And lastly, stop losses may reduce the emotional aspects of investing in that once a stop loss order is placed, the stock will be sold at that price regardless of how the investor feels about that individual stock. There are a few cons of stop loss orders. A short-term price change that could be driven by a short-term related news or non-stock related news may cause the stock to decline and then trigger the stop loss at that price. That could trigger the stock to be sold at a less attractive price in the short term. And if the stock recovers the price decline in the short term, the intermediate or long-term return the investor may have been better off by simply holding the stock down and then riding it back up. For example, the S&P 500 index averages at least one 5 to 10% correction every year, according to investing.com. And if the whole market goes down 5 or 10%, that could trigger a stop loss in any stock down 5 or 10%, but then the market could recover all those losses relatively quickly. However, the stock, again, could recover that loss by the end of the year or within a matter of days, depending on the correction of the individual stock. Stop losses and hedging may increase transaction costs and tax impact, as both may increase in overall investors trading, but relative to simply buying and holding high quality companies and holding them over the long term. Stop losses and hedging strategies may potentially reduce a long-term equity investor total return, as the S&P 500 index has compounded at approximately 10% over the long run. Analysis from the Hartford shows that a $10,000 investment in the S&P 500 index from 1994 to 2023 would reach a value of roughly $181,000 for a fully invested portfolio over all of those days. If that same portfolio misses the 10 best days in a 30-year period, the value of that portfolio would drop to $83,000. So a 54% drop by simply missing the 10 best days. The key challenge with a stop loss or hedging strategy is that an equity investment may turn into cash at the exact wrong time when in one of those 10 best days, which could dramatically reduce the total return of the portfolio. Again, we believe a key to investing is time in the market, not trying to time the market.
I love that, Whitney, and thank you so much for sharing your knowledge. You've been doing this for 18 years, but you've been in the trenches with some amazing mentors around you during the whole time, and to come on this show and really your knowledge is just oozing, which is awesome. This is a show that I'm excited to do. I'm grateful that you were able to take time from your busy schedule to come on this show. And is there one thing that you'd like to leave with our audience?
I would just simply say, develop a plan, work with your financial advisor, your professional, develop a plan and stick with the plan that gives you potentially the highest probability of getting to your long-term financial goals. And once you develop that plan, you have the discipline to stick with it.
Love it. Stick with it. And Thank you, Whitney, for, again, spending your time here. You're listening to Saving the Investor. I'm Alfie Townsend, Southwest Florida Certified Financial Planner Professional, here with John Antonucci. And this was a great show, John. It was something that I think our listeners are going to love.
Yeah, fabulous show. And I think one of the greatest things that he said is in a 10-year period, if you pull out 10 days in those 10 years, you can lose half of your portfolio. Isn't that amazing?
Yeah, it is. You want to stay invested and buy on the dips also. That's what rebalancing is all about. So, again, you're listening to Save the Investor, and John's going to give you our number one last time.
Yeah, it was a great show today. You know, that's all the time we do have. But before we sign off, we do have a special offer. As always, Alfie's book has been flying off the shelves, and due to popular demand, he's making a limited number available, complimentary to you once again. His book is a roadmap to a fulfilling retirement. It's called Making Waves in Retirement. To get your book, just simply call the operator or text the word book, B-O-O-K, to 239-747-1077. Don't miss out on these valuable insights. Text the word book, B-O-O-K, to 239-747-1077.
Thank you, John. And I don't know if you ever seen our TV show. It's called Saving the Investor, and it's on every Sunday at 11 o'clock, and right after Meet the Press. So if you like our radio show, you might love our TV show. It's in living color, as they say, and we can show you a lot of these things that we're talking about here. And again, we've been here many years on 92.5. So thank you for listening all these years, well over 10 years. And Jake, the millennial, helps us, big time, to make us sound good and really take care of all of our mistakes that we do have, because we are humans. But again, you're listening to Save the Investor, and we had Whitney, and we're going to put this on our website for many years to come, and many months to come, and days to come. So if you like to listen to this again, you're going to be able to go on that website. That's the Saving the Investor. You can go on Saving the Investor Advanced Retirement Group and listen to this again, because there was a lot of information that Whitney talked about, and I think it's information that you're going to need for the long haul. So until next week, be blessed.